Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the CPI data and what we learned from Fed Day. Plus, should we be worried about the number of underwater homes? Logan, welcome back to the podcast on CPI Day and Fed Day. You must be having a field day with this.
Yes, it's been a fun morning. Powell is actually still talking. He's getting toward the end of his Q&A, but all I have to say is labor over inflation. Now the CPI data, the month-to-month data came in much cooler. It wasn't because shelter inflation really pushed that. Some of the core inflationary data that have been looked upon as not going to be very useful in bringing inflation down, automobile repair, stuff like that, were coming in less. So that shocked a lot of one. The 10-year yield just made a waterfall dive. The 10-year yield made a vertical move after Jobs Friday. So we're kind of just back to where we were right before Jobs Friday came out. But today's Fed presser, crumbs, right? What are you talking about, crumbs, Sarah?
They lead us. We can follow the crumbs. I don't know. What are we talking about? Crumbs?
Yeah. Oh, well, you and I have to cook and bake a cake someday for everyone at HousingWire. I'm sure that'll be fun. Mother Economics, she's a serial killer, right? She will leave you crumbs. I think today, Powell, quietly, I saw some people pick it up, left some good crumbs. So with the theme of labor over inflation, he finally said it today that the labor data is basically kind of pre-COVID. And I was wondering if he was going to wait until job openings get to 7 million to say that. Because my argument is that the labor market is no longer tight. It hasn't been tight for a while. The job openings, if you look at the trend of it, adjusting to population and the labor force, it looks where it should be in a normal marketplace, no longer a tight. So the fact that he was willing to say that in public shows to me is that they're in the background starting to be a little bit mindful that this is no longer the super tight labor market, and wages, they talked about wages, wage growth is cooling down, the whole wages spiraling out of control, labor forces, people have too much power over their bosses, stuff like that. He brought that finally down to, okay, we're kind of pre-COVID. That is very good about going in the future. And second, and this is another thing that is key, when I go on Instagram stories in the morning when we have CPI day, because it's 5:30 morning my time, I talked about, the base effects are going to be a little bit more difficult going out in the second half of the year, especially in the summer. That means that last year we had some really low prints, and that's going to prevent like the year over year data from falling. He talked about that today. That's very key. Like they know that is going to be the case. So they're not going to like get freaked out if you saw some increases on a year over year. They're going to look at that month to month data. And the reason the 10-year yield fell right away is that the month to month data was pretty cool. Now, again, CPI inflation is not what the Fed tracks. When Powell comes out and says that we had 7% PCE inflation peak and now we're at 2.7, he's doing that on purpose to get people kind of away from the CPI data. Everyone loves CPI inflation, but it's 45% housing, shelter. So the PCE inflation and the PPI inflation, which is going to come out tomorrow when this podcast comes out, are key. So I think it's constructive in that. There are some questions. Well, hey, will the Fed change their language because of the inflation data? They can if they want to, right? Because they get the data and then they tell everyone, they say, hey, listen, you have this really big report. If you want to change your things, go ahead, do it now before we make the results. So it's there. And there was no fireworks, but there were crumbs. And those crumbs are good, right? Because to me, when the labor market starts to really break, right, they've laid the groundworks for that to be the driver, because they're not forecasting like 2% inflation until 2026. Right. So I think it is useful in that context. And we're at a very, very key level on the 10-year yield. We're going to need some weaker data or something to really push this lower. He had the opportunity if he wanted to do that, but he kept it kind of even keel, but he gave crumbs about going out in the future. I think that'll be key because for me, it's always about the labor market, and we structurally focus all of our economic work around that. That's why it's a very geeky technical take. But today I thought it was useful in that context.
So it's been kind of a, a little bit of a whiplash if you think about before the jobs report came out, right? We were seeing lower rates. And in fact, that's why the purchase apps today were stronger. And then, jobs report comes out, shoots it up. CPI comes out, goes back down. This is crazy.
It's interesting. Purchase apps were up 9% week to week. Normally that'd be a really strong number. Just always remember, I try to say this when I go on Twitter or X and talk about it. When you're working from extreme lows, it doesn't take much to move the needle. And the previous week, we're down 4% week to week, which was a weaker than normal trend. And then all of a sudden here we have 9%. So rates are moving up and down, very volatile, but it's still in the upper range. The key with all housing data is duration, right? So to me, tracking purchase application as long as I have, you really need about 12 weeks to make a material change. We saw that at the end of November of 2022, going to up to the first week in February of 2023. Literally just that 12 weeks of kind of positive data line trend, pushed out the inventory seasonal bottom up until April 14th, which was the longest time ever recorded in history. So it's a start, but you could clearly see what's happening. My God, people if rates could get down to 6%, you have people just sitting there waiting. Right? They could qualify, that payment's more comfortable for them and everything, but it's just 1 week move is not good enough. You need a duration. And one of the things I try to teach young analysts is that when you look at purchase application data, it's very seasonal. You really want to weight it the second week of January to the first week of May. After May, total volumes always fall. The trolling crash people would always go, oh my God, purchase application data collapses all the time. In the second half, that's what it does. Now, post-COVID, we've had some extreme abnormal purchase application data. It always tends to rise in the second half, especially toward the end of the year. Now, there was the COVID-19 makeup demand. There was the abnormal 2021 when rates were going lower. And then the last 2 years, rates just fell, and we just picked up on the weekly data, and that's it. When demand is really recovering, it'll be so easy to watch. These charts that I do and these black lines that I draw, there won't be basically, I will stop talking about Gangster's Paradise and No Doubt, and we're no longer chasing waterfalls, the 1990s music, right? I had the Kid and Play haircut back in the 1990s playing basketball, right? So all that goes away, right? No more 98 Degrees or Backstreet Boys. We're moving to the 2000s. So we're not there yet. But you could kind of see that the market is just waiting. And my argument has been that the builders have shown you the way to grow sales. That uptrend in sales has been here since 2022, but they're like a 4.5 to 5.5 mortgage market, right? When they need to be, they'll lower rates. Existing home sales market isn't as efficient as that. So lower rates, and there it is. There it is. That's all. It's good stuff. But the fact that Powell said today that their pre-COVID labor data, I was worried that he was going to wait till 7 million, and that 7 million to me is actually the quits rate is ahead of the actual job openings number. So I am glad to hear that they don't believe that to be the case. So again, any weakness in labor data at this point, now we have a firm check in place about, okay, we'll focus on that. That'll be our dual mandate. So it's kind of worked out in that sense, that whole labor over inflation. The last, few Fed meetings, we can finally connect the dots to a pathway to the future.
Okay, so let's talk about that pathway a little bit. Did you feel like, first of all, and this is not anything to do with the Fed, but on the 10-year after the jobs report, do you feel like that was kind of an extreme reaction to what we really saw with jobs?
No, because one of the things I always say, itchy fingers, crowded trades. Right. We have bond volatility And like, for example, the bond market was like pricing in like 6 rate cuts. The Fed never talked about 6 rate cuts, but we've done this twice now where 10-year yield goes very low. And, in 2023, the whole Gandalf line is like, we really shouldn't break here. You shall not pass. Okay. And the 10-year yield kept on trying. And I'm like, I just don't see the labor market breaking like you think it is. So 10-year yield's gone up. We did the same thing last year. We got all the way down to 380 on the 10-year yield. I'm like, wow, boy. But when you have a crowded trade and itchy fingers, boy, these moves are very fast. It's funny. I literally do this on Instagram stories. I go, oh my God, look at that. Somebody's ready to party. Oh, no, somebody's ready to pass out. Waterfall moves like that just shows me that you have nervous traders who are all crowded into one thing and they all get out, right? Like bond market traders are like depressed people. Like I don't know, they're just different. Stock traders are just crazy, but bond market, it's a whole different ballgame. But at key technical levels, and we always do this, we go at that kind of that 4.34 level. Boy, if this breaks down lower, that's a material change. That uptrend that we've seen on the 10-year yield goes away. So I think bond traders are mindful of that. I think the computers and the quants are all mindful of that. So these headlines are very, they can move in that regard. In fact, let me take a look at where the 10-year yield is right at this very second, because I think Powell is probably almost done or either done. And we have seen a kind of a 4 to 5 basis points move from the lows of today when the Fed announced. So nothing too extreme. We got down to kind of like the 4.25 level, and then we bounced up a little bit. So considering everything that's going on, this is the week is positive in that sense. We did not try to break above to get to 5%. And again, the spreads are good, right? And it could be a lot worse, Sarah, this year. If we had another banking crisis or something that created the spreads to get worse, we're 50 to 60 basis points higher already, and that doesn't do anybody any good. And Powell talks about that today about the housing market. What do we do about the housing market? And they're like, we're still going to have a shortage no matter what, so, but, we want to get inflation down so we could get rates to come down, and that'll help out the housing market. So thankfully, to Fed staffers, thank you, no more. The housing market is recovering. You've tore those stuff out of the Fed's president's speeches, and it's more realistic now. That demand's not growing. We're not having a rebound in home sales, but we need to bring inflation down. Then rates could come down, and that'll help the housing market. Okay, so a bone thrown to that direction rather than the housing market's recovering or the housing market is holding up well. It's like, dude, it's the third calendar year of the lowest home sales. What are you on? So good in that stuff. That's a good crumb considering where we are right now.
We will take the crumb because, like you said, I mean, it's been a very paltry place over here in housing where they seem to have completely lost touch. I do think that what you see is that Main Street frustration making its way to the Fed, making its way to the White House, making its way to Washington. And I know those things aren't connected. Like Biden can't tell Jerome Powell what to do. But I mean, clearly the housing market is not in good shape.
Oh, and again, when President Biden brought out that, I'll give you $400, I'm like, that's not the growth rate of inflation. Again, I have a much different, I would have handled the rate situation differently in the Fed, but I'm just one person, and thankfully one person never has that much power. But in this case, like I've stressed in other interviews, if you could just get mortgage rates down to 6% and stay there, 6% is elevated compared to what we had in the previous decade. And remember, the previous decade was 3.25% to 5% range for like almost 10 years. So, but 6% at least gets you things moving, and you don't have to like, okay, here we go, 6%. Oh, we're back to 8% again. It's just, you look at the growth rate of inflation right now, and if the spreads were just normal, it is what it is. That's pretty much what we would get. We would get, 6% or even a high 5% mortgage rates right now. And you could work with that, right? I'm not looking for like a big rebound, but you have something you can move with. Now, again, the counter to me is the other side of me saying, okay, the best part about housing this year is inventory growing, right? So I need to get off of these levels, and that's always my primary thing. But I understand the frustration because it's the third year. And what do we do as Americans or as human beings, right? Forget Americans, we're human beings. We date, we mate, we get married, we have sex, we have kids, we buy homes. This is what we do. And it's just like, this is year 3 of the lowest home sales ever. And it's not like we have 85 million people working. We have 158 million, almost 159 million people working. We have very good demographics for housing, okay? Millennials have regained back the prime spot as home buyers, but sales are very low. I stress this. You can't compare this to 2008 because 2008, we had a lot less people working. The demographic shifts were a little bit different. So here, it's just like, so it is terribly frustrating. I get it. But again, the positive side for me, I'm of course structurally biased here. The growth rate of inventory is picking up and we're getting off of those levels. What we didn't want to have is like active inventory be around 300,000 and all of a sudden then rates drop at that point. That's like, oh, that's savagely unhealthy. But at least now we have a buffer, and that's a good thing about the buffer. It's a positive trend. It is probably not the best news for the people that said the mortgage rate lockdown can never let inventory grow, but we'll forgive those people. We'll forgive those people.
I'm not sure those people ever said inventory can never grow.
Speaking of which, was Sean Dobson was telling people to like, hey, sell your house, go rent, and then wait, and then buy your house again, and that, oh, geez. It's a funny story is that my very first National Economics Housing Conference in Austin, Texas in 2016, I was debating Sean Dobson because he was saying lending was tight. And I was like, no, it isn't, and I remember Rick Shager was moderating. I say, hey, Rick, remember this event? He's like, oh yeah, I remember that one. There was not a series of, there was a lot of, very strong views on that debate. So I hate to break it to you guys. This might be like news breaking, but people don't trade homes like they trade stocks. So again, we always talk about this. Guys, you don't want to do this. You don't go to your wife and kids and go, honey, kids, we're going to sell our house. We're going to go rent somewhere where it's really cheap. And then we're going to wait for the 200-day moving average of the Case-Shiller home price index to come down. And then we're going to wait for the mortgage rates to come down. And then when you guys are all in your 30s, and say goodbye to your friends, then your mom and I will buy a house. And your kids are going to go, what? Dad, what are you doing? I got to go to school here. I'm going to go to high school next year. What do you want? No, your wife's going to go, what do you mean we're going to move? No, honey. Yeah. So people don't operate that way, right? There's nothing that we've seen in the data where we see a mass sell to rent and then people waiting. Could you imagine, Wheeler, somebody doing that in 2013? Because I always hear these guys tell me, oh, I just sold my house. These men are so pathetic. I literally every year I always have, I sold my house and I'm renting. Literally the trolling people who don't even show their names always tell me they sell their house and they're renting and they're waiting. Imagine how that worked out for you, right? And even like in 2020, early 20, oh, I sold my house and I'm just going to wait for home price to crash and you idiots are going to buy this. And then it's like, okay, that didn't work out. Home prices went up 47% and then now rates are up. So I just don't think general functioning adults do that. I think spreadsheet people, there are some crazy spreadsheet men that I've met and they're like looking at all these things and they're like moving their families around. So a little bit cuckoo, right? They tend to have, they're on their third marriage, but still, I give the spreadsheet people, they are strict to the spreadsheets, but people just don't operate that way, right? And there's nothing in the inventory data, especially post 2010, that will go to that way. And then the underwater mortgage thing came up again.
Okay, well, that's what I was going to ask you about next, but I guess I have to call you Mohtashami since you're calling me Wheeler at this point.
Yeah, you go ahead. You call me Mohtashami. I'll call you Wheeler. And then we got to think of a cake we're going to make. I figure we got to do crumbs. Next time I'm in Dallas, we're going to bake a cake together. All right. And we're going to give it to the HousingWire, the reporters.
You have no cooking skills. Is that correct?
I have no cooking skills, but it's going to be fun to watch. Right. I'll be like drawing charts with flour or whatever and stuff. And, so.
I have some cooking skills. Okay. So Mohtashami, You just wrote an article today about, do we need to be worried about the number of underwater homes that we have? Because we had a recent report, I think, from Adam that said 1 out of 37 homes is now seriously underwater. And then you wrote something based on CoreLogic data. So kind of bring us up to speed.
I think CNN brought up some underwater
Oh,
story
that's
again.
right.
Man, CNN is 0 for 2. Oh my dear Lord. Come on. Come on. Underwater mortgages. So, okay. So I thought, what is the best way to talk about this? So, of course, I go on Twitter where all the demons and trolls and orc armies work. And I said, okay, CoreLogic data, 1.8% of all homes that have mortgages are underwater. Okay. That's 1 million. It's the lowest levels ever recorded in history. But okay, there we are. So let me go back to 2010. In 2010, 23.1% of homes were underwater. And, it was a little bit above 11 million homes. Okay, so they're right there. So for the Housing 2008 guys, there is a part of me. I actually, the softer side of Sears came out. And I thought to these guys have been dancing with a ghost for like 16 years. Like, could you imagine if you were in love with someone so much and they died in 2008 and you're just dancing with this ghost for 16 years, fantasizing about this wonderful time in your period where people were losing homes and foreclosing and you hate the Fed so much and you blame the Fed. And these men have been literally dancing with a ghost for 16 years. So you kind of feel bad for them that they can't move on, right? So it is what it is. In any case, I thought putting it in that context is a good reference for everyone, but also saying, okay, so this is good, right? We don't have an underwater mortgage problem, and this is not even counting the 40% of homes that don't have a mortgage. But what's even better than this? The qualified mortgage home financial profiles, excellent, right? So one of the things I try to teach people every Saturday, I think some of you follow me, especially on Twitter or Instagram, I always take the new listings data for the week, either 2008, 9, 10, or 11, or 12. And then I compare it to this week. And back then we had 250 to 400,000 homes per week going into the marketplace. Another way to kind of think of it, in 2011, it took 105 days to close a transaction. That's days on market, NAR data. The NAR data last month, or the last report, even with the third calendar year of the lowest home sales ever, 26 days.
Yeah, I mean, over 100 days is crazy. That is crazy.
This is two different marketplaces because it's two different credit models, right? So back then, those sellers weren't buyers, right? Those new listings, right? You had a lot of stressed foreclosure stuff coming to the market, and you have to realize that credit market died really when qualified mortgage came in. And then we had this long economic and job expansion, the longest economic and job expansion. And she's not coming back, guys. 2008, she is not coming back. There are people you can go to resolve this issue. But while you're still living on planet Earth, you have to let her go. 2008 housing's not coming back. Sorry. Okay. Maybe when you pass off to the afterlife, you might see her in the devil's den and you could hold hands and joy about when all hell was breaking loose, but not on planet Earth today, not in the United States of America.
Oh my gosh, that is hilarious. I mean, not hilarious, but yes, funny. So from your perspective, Mohtashami, it's sort of funny. Okay, I will give you that. So we're at 1 million homes that are, significant, like seriously underwater. 1 million compared to.
Oh, no, I mean, just 1 million homes that are underwater. So literally, there's a percentage data line of 125% LTVs, and that thing, for example, I showed a guy that in 2015 this was 4%. In 2015, we had 125 LTVs at 4% of the market. Now it's 1%. That data line is always there, right? I've never seen it actually really break under 0.5%. So it's actually the 1% level is actually very low. So just realize that late cycle lending risk is legit. There are people, let's say if you bought a house in Austin at very low down payments in 2020, technically you're underwater. So that's a technical foreclosure risk. If you lose your jobs, that is always going to be a part of the housing market, regardless of anything. But in scale terms, it's not even close because the credit structures, right, are so different. And we always do this, that one chart we love, right? The foreclosure bankruptcy charts, and housing credit was breaking in 2005, 6, 7, 8. Yay, yay, 2008. Recession is here, but she's dead. 2008 is dead. It's not happening. So the irony is that I did a duration timeline. You would need at least like 7.8 years of like credit stress breaking from where we are right now, realizing that we're using 30-year fixed mortgages to get up to like 2008. And, some of these guys might not even be around 7-8 years from now. So let's let that period go. When we see stress in the data, we'll get it first. New listings data. Trust me, she will go vertical, right? It's working from such low levels. And just remember, pre-COVID, 2013 to 2019 data, the seasonal peaks were running about 80 to 110K. Okay, so in that context, we're not even back to pre-COVID levels on new listings. So stress ain't there. Hey, remember, you know what nobody talks about anymore? Nobody talks about the Airbnb bust. That's like that. Like nobody talks about that anymore. I wonder who basically shamed that to the absolute oblivion, right? So yeah, that's done. I don't even see those stories anymore. But we'll track it for you guys, and trust me, like we always say, you won't miss anything because I don't have a life Friday nights, man. You know this, Wheeler. Friday nights, I'm like, oh, here it is. New listing data. We're doing the tracker. So let the data roll into weakness, just like jobless claims and all the labor data. It's a trend. We'll go with the trend. But it's just the underwater story is just not the same. There's always late cycle lending risk, but it's just the whole market structures are different. So hopefully that 2010 example and 2024 example, it's 14 years. Kind of, come on, you got to let some things go, guys.
Pretty stark contrast. Well, Logan, thank you so much for being with us, listening to the whole Fed speech and the presser so that you could give us the latest intel.
So what are we cooking? What kind of cake are we cooking next time?
I don't know.
in
What
Dallas?
kind of cake do you like? I like everything. If it's sweet, I like it. So, and good for you. I will, on this one, I'll be the one who has the expertise. I know how to cook, so I can make a cake.
Okay, but you got to let me try. Then you can take videotapes and everyone could laugh at me because I don't cook. I'm a DoorDash 24/7 guy, but something we could experiment later on.
Okay. All right. A cake is in our future. Thanks for being on today, Logan. I'm sorry. Thanks for being on today, Mohtashami. And we will talk to you again in a few days. Okay. Bye.
Bye.